Today is Friday, September 23rd, and this is the ADM Investor Services Weekly Market Review. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. Today's guests are Steve Freed, the Vice President of Grain Research at ADMIS, and Alan Bush, the Senior Financial Economist. Steve, U.S. corn and soybean harvest is slowed this week due to rains. How has the market reacted, and what do the early yields look like?
The market initially rallied on this slowdown there because they were especially concerned in beans that, given the low carry-in, that this might tighten the supply. But it seems like farmers are getting crops harvested between raindrops, and right now we're estimating the corn harvest might be close to 20% done, which is near average, and beans 9% done, which is also near average. So market has kind of now taken back that weather concern, and we're down 30 cents for the week and off the highs in the beans.
Yields?
Soybean yields are unbelievably impressive. You know, the USDA is estimating an average yield of 50 countrywide, and we're hearing a lot of 60s, a lot of 80s, and things like that. So the yields are phenomenal. Corn yields are coming out really good, but not like the record that we saw in 2014. So it might be just a little bit below the USDA's 174.
Is the farmer selling cash or storing most of the harvest?
We've seen a big collapse this week in the domestic soybean basis. So when he's getting like one farmer in Iowa, 80 bushel on his entire farm, he sold every bit of it. And so you're seeing that he's selling the beans. So far, right now, the pattern is he's selling the poor quality corn, but he's storing the other corn. So he's selling the beans and storing the corn.
So with the beans, even though prices may not be where the farmer wants it, the extra yield, the higher yield is helping him.
Yeah, and every economist, every farm manager is telling him to just get rid of the beans. And so that's what he's doing, because he is making a little bit more money per acre with these higher bean yields than he is in his corn.
And what's the latest on the outlook for the U.S. farm economy in general?
Well, it costs about $800 to put a crop in the ground. So 200 bushel corn at $3 is $600. 60 bushel beans at $9 is $540. So you're seeing that he is harvesting a crop below cost. And so there's talk of that maybe 80% of his cash flow he's lost this year, and that 80% of the farm loans this year may have to be restructured. And so the farm economy right now is weakening.
Still pretty concerning.
It's very concerning because now the restructure has to go in the equity of the farm. And so the farmland values is now his key to his operating costs. And the University of Illinois came out and said they don't think 17 prices are going to get any better. In fact, they may even go lower.
Staying on the grains for a minute and looking at the board, all the grains seem to be trading in a fairly tight range. What will push the market out of these ranges, and what types of market strategies should risk managers be using at present?
Well, I think right now we've got a September 30th grain stocks report. And so in 2014, it was a surprise on the bullish side because they don't count grain in transit. So the first thing that could happen is if they came out with a lower stocks number, we could actually see a little bit of a rally and test the higher end of the range. Then we've got to look at South American weather. And right now, in talking to some of the weather people, if it's normal, we could test the lower end of that range. But for the most part, when you got record demand and record supply, you'll probably stay in that trading range. Now, Hightower is very bearish. They're looking at a soybean yield as high as 53. So they came out with a strategy of buying July 960 puts and selling $11 calls for 14 cents. And they look for it to go as high as 79 cents. So if I'm a farmer or if I'm a trader, this type of buying the put, selling the call spread might be advantageous.
Export sales are above pace, maybe record high. Is this enough to support prices?
It should support prices. We might be losing a little ground to competitive of the Black Sea, but I think that if we hold 940 beans and 310 corn, it's because we're going to have record exports this year.
I know it's early, but looking into the future, do you think the farmers will increase bean acres in 2017, reducing both corn and wheat, and how would this impact prices?
I think the market was shocked this week when one of the private analysts came out and said that farmers next year are going to increase bean acres by 4 million. And every economist is telling them to plant more beans and less corn and wheat. Now we've got too much corn and wheat, so it doesn't impact corn and wheat if they lower the acres, but it could be very bearish beans if they increase bean acres 4 million next year.
Alan, let's look at financials. On Wednesday, no surprise that the Fed opted to keep interest rates unchanged, but they did signal that they're likely to raise rates before year end. What is the probability that they will indeed raise the Fed funds rate in December?
Okay, first of all, most likely the Fed will not be raising rates before the election. There is another Fed meeting November 2nd, so they tend not to make policy changes before any type of political events. But as far as the December meeting, there's roughly now a 55% probability that they'll raise at that meeting. Our feeling is that there's a very strong possibility that they will hold off on raising rates even in December, and even though that is the consensus view. So I'd be looking more toward next year for a possible rate increase from the Fed.
However, all year long, we've been saying that they probably wouldn't raise until December, and if they would raise it all this year, it wouldn't be until December.
Exactly, and it's also very hard to raise rates when other central banks around the world are in an easing mode or likely to add more accommodations, such as the Bank of England could lower rates before the end of the year. The Bank of Japan, the same thing. ECB is a very large accommodation mode, buying assets. So it's very difficult for a central bank to buck the trend when other central banks around the world are going the opposite way.
Let's talk about that for a minute. Europe, some of the other places with negative interest rates. How long can a country, maintain a negative interest rate situation?
Well, it was thought that negative interest rates at one time was an impossibility, and now, as we've seen, that that is of course not the case, with much of Europe having negative interest rates. How long can they stay negative? Apparently a lot longer than people are anticipating. Even the Bank of Japan, who has negative rates now, are likely to make their rates more negative. So it's an open-ended question. I think once central banks realize that negative interest rates do not produce the desired result, they may start to abandon that policy. And I think ultimately governments are going to have to start looking at fiscal stimulus, because monetary stimulus is starting to come to an end as far as its effect on the economy.
We saw the dollar come under pressure after release of the FOMC statement. What is your outlook for the U.S. dollar now?
Traders were very disappointed, at least the longs were disappointed that there was no rate increase from the Fed. So with the dollar under some pressure with no rate increase, our feeling is, though, that the Fed is the only central bank that could raise interest rates this year or next year. Other central banks, as we mentioned, are still in no position to raise rates in any form. So the dollar index will probably hold up. In fact, today the dollar's putting in a good performance after being lower in the overnight trade. So the dollar should be bought on breaks. I would not look for a straight up move, but a sideways higher move for the dollar index over the next 6 months to a year.
Within the Fed statement, policymakers indicated inflation expectation measures are little changed. Do you agree with these expectations?
Not at all. In fact, when you look at precious metals and what they've done the first part of this year, there was a massive advance in gold and silver, which is basically an inflation play. So even though the Fed apparently does not see inflation now, we are seeing inflation developing, and we have turned a corner from global deflation last November to the first signs of inflation in that same period. Also, commodity prices, at least the broad indices, have bottomed in the first part of this year. So even though the Fed is not looking at inflation, apparently not worried about inflation, the things that we look at suggest inflation is coming back and it will gradually accelerate. To protect yourself, you definitely want to be long the precious metals, gold and silver, on breaks.
The stock market is again nearing highs. I think the NASDAQ may have made a new high
Yes.
this week.
Right.
Is it your position that stocks are in good shape generally?
Absolutely, as long as interest rates stay low globally, and even though there is a threat of a Fed rate increase somewhere, this low inflation level that we're currently seeing and is going to accelerate will ultimately be supportive to the equity markets globally. So we're still in a bull market for all of the indices. So look for continued gains all this year, possibly well into next year.
Steve, I'll ask you finally, what's hot and what's not?
I think Alan pointed out that with the lack of Fed action, the equity markets should continue to move higher. So that's a hot market. We also noted that globally, sugar stocks are down, and sugar's making some 4-year highs, and so that market is hot. In talking to our weather guy this morning, he was talking about there's a chance that the northeast part of the United States could see extremely cold weather this year. So you have to kind of watch the heating oil market and see if there's any reaction there if that unfolds. But in general, with this Fed action, you're seeing too much supply in commodities, and in general, most commodities lower. So commodities are not hot. The equities could be hot, and watch heating oil for this winter's weather.
Remember, the views and opinions expressed here today on this video are solely the views and opinions of our guests, should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. If you'd like more information about our services or would like to open a trading account, please visit www.admis.com.